$500,000 just became $250,000 after-tax windfall, and your beneficiaries won't know until it's too late. Most life insurance policies carry a silent ownership flaw that converts what should be tax-free death benefits into fully taxable ordinary income. Your advisor probably never mentioned this rule. The IRS calls it Section 101J. And if your policy structure doesn't match it, your family faces a tax bill so large it can wipe out 45% of the death benefit. Wait, if you think your death benefit is protected, keep watching. By the end of this video, you'll know exactly how the Section 101J trap works, whether your policy triggers it, and why waiting until death to discover this is financially catastrophic. Here's the wrong belief most people carry. Life insurance death benefits are always tax-free to the beneficiary, no matter who owns the policy or who is named as beneficiary. That sounds logical. It's also incomplete, and it costs families hundreds of thousands of dollars every single year. The correct reality is this: IRC Section 101J requires that the policy owner and the insured be the same entity, or the beneficiary must have no interest in the insured's business, or the policy must be grandfathered under pre-2010 rules. When those conditions fail, when ownership is split across multiple parties, the entire death benefit gets taxed as ordinary income, not capital gains, not tax-deferred buildup. Ordinary income, taxed at your marginal bracket. This is the difference between $500,000 inheritance and $250,000. Let me show you the exact dollar impact. Imagine a household earning $250,000 annually. $500,000 death benefit arrives. Under correct ownership structure, $500,000 arrives tax-free to beneficiaries. Under Section 101J, that $500,000 becomes taxable ordinary income at a 37% federal bracket, 5% combined state tax, plus the 8% net investment income tax. You're looking at $220,000 in total tax liability. The family nets $280,000. That's a $220,000 loss, or 44% of the intended benefit, vanished to ordinary income taxation. Worse yet, that tax bill hits in a single year, potentially pushing the beneficiary into an even higher marginal bracket for other income sources. Here's where it gets worse, and you need to hear this. Most policies with this ownership mismatch were purchased 5, 10, or even 15 years ago. They remain non-compliant today. The business owns the policy, but the spouse is the insured, or a trustee owns it while the employee is covered, or the company is named beneficiary while someone else is the policyholder. These mismatches were baked in at purchase, and nobody flagged them. The policy stayed in force, and the beneficiaries discover the tax trap only at death, when remediation is impossible. That's when a $500,000 promise becomes a $250,000 reality. The three-entity test is straightforward, and this is critical. Treasury Regulation Section 101-1D states, a death benefit escapes Section 101J taxation only if the policy owner and the person insured are the same, meaning the insured owns it outright, or the same entity, business, trust, that owns the policy is also the insured. If the owner and the insured differ, and the beneficiary has any business interest in the insured, ordinary income treatment applies. That's the rule. That's what determines whether your beneficiary gets $500,000 or $250,000. Three common violations we see constantly. First, the spouse owns the policy, the business is beneficiary, and the employee is insured. Ownership is split across three different entities. Second, the business owns the policy, the spouse is beneficiary, and the employee is insured. Again, split structure creating Section 101J exposure. Third, a trust owns the policy, the beneficiary has business rights or employment interest, and a different person is insured. All three trigger Section 101J. All three convert tax-free death benefits into ordinary income, and all three are discoverable today if you audit your current policies right now. Here's what to do immediately. Pull your last life insurance policy statement. Look for three critical items: the policy owner's name, the insured's name, and the named beneficiary. If all three are the same entity or person, you're compliant and your $500,000 benefit stays tax-free. If they differ, and the beneficiary has any business or employment interest in the insured, your policy likely triggers Section 101J. Contact a licensed tax advisor or CFP. They can review the ownership structure and, in most cases, reassign ownership before death to cure the violation permanently. After death, it's too late. The tax code rewards those who study it before the deadline.